Welcome back. So, if you've been watching the markets in early 2026, you know it has been a wild ride. It really feels like the old rules of economics just don't apply anymore. Today, we're going to break down exactly why the game has fundamentally changed. This quote right here really hits the nail on the head. It perfectly captures what's going on. Things like political turmoil, debates about institutions, and policy fights, they aren't just background noise anymore. They are the main event, and honestly, they're often moving markets way more than the traditional economic data we used to obsess over. So, that's the big question, isn't it? In this completely new landscape, what are the real forces causing these huge seismic shifts and where all the money is going? Okay, let's dive right into it. Our story really starts with this backdrop of what you can only describe as a chaos cocktail. It's like the whole world is simmering with all this instability, all at once, and you can bet it's making investors incredibly nervous. The sheer number of hotspots all firing up at the same time is what's truly staggering. We're not talking about just one or two isolated problems here. You've got geopolitical flare-ups happening all over the globe, and at the same time, these intense political battles right here in the US over things like the Fed's independence, Supreme Court rulings. The level of uncertainty is just off the charts. So, how are the markets reacting to all this chaos? Well, pretty much exactly as you'd expect. We're seeing a classic flight from risk. Investors are spooked, so they're pulling money out of things they see as risky, like tech stocks, which is why the Nasdaq is down. And even crypto is feeling that pressure. So where's all that money going? Straight into traditional safe havens like gold, which has absolutely been surging. But here's where it gets really interesting. All this global chaos is also creating the perfect storm for a massive shift within the US markets. It's a phenomenon that people are calling the Great Rotation. Let's take a look at how this is playing out. For years, it felt like the market was totally dominated by the old guard, right? The huge mega-cap tech stocks, the so-called Magnificent Seven. But that's changing. Capital is now aggressively rotating into a totally new set of leaders. Things like value stocks, smaller companies, and those cyclical sectors that are really tied to the real physical economy. So why is this happening? Well, it boils down to three main things. First, the Fed has started cutting interest rates, and that's a huge boost for smaller companies who are much more sensitive to the cost of borrowing money. Second, the tech giants are actually facing a slowdown. They're spending billions and billions on AI infrastructure, which eats into their profits, and investors are showing signs of what's being called valuation fatigue. Basically, they're looking at the price tags and thinking they're just too expensive to keep climbing like they were. And third, certain government policies are giving smaller, domestic-focused firms a real leg up. The crucial point here is that the entire economic and political environment is tilting the playing field, and the results are crystal clear when you look at the performance. Sectors like materials, industrials, and energy, the backbone of the real economy, are now leading the pack. And meanwhile, the old leaders, tech and financials, are lagging behind. It really signals a shift towards a much healthier, more balanced market. Now, get this. At the very same time all of this is happening in the US, there is an economic earthquake rumbling across the Pacific. I mean, for the first time in decades, Japan is going through a truly historic economic reversal. And it all comes down to this one number, 1%. That's the interest rate Japan is forecasted to hit by the end of 2026. Now, I know that might sound tiny, right? But for a country that has been stuck in a world of deflation and basically zero interest rates for decades, this is a monumental shift, and it has massive global consequences. Japan's economy is finally showing real signs of life, and it's moving back towards, well, normal. But this transition is anything but smooth. Right now, its bond markets are in what's being called a bloodbath, as yields are spiking up, creating a huge dilemma for the Bank of Japan. Okay, so to understand why this matters to the rest of the world, you have to understand a concept called the Japanese carry trade. It sounds complicated, but the idea is actually pretty simple. For years, investors could borrow money in Japanese yen for almost free, and then take that money and invest it in places with much higher returns, like US bonds. This one strategy flooded the entire world with trillions of dollars of Japanese capital. And this is exactly why that whole era is ending. While US interest rates are coming down, Japanese rates are starting to go up. So that gap, the difference in returns that made the carry trade so profitable for so long, it's shrinking, and it's shrinking fast. The incentive to borrow in yen and invest in the US is basically just evaporating. So now, let's connect the dots.
We've got this major rotation happening in the US market, and at the same time, a historic economic reversal happening in Japan. When you put those two forces together, what you get is a powerful global ripple effect.
So what does all this mean in practice? It means the carry trade is unwinding. As that profit motive disappears, there are huge concerns that Japanese investors are going to start selling their US assets, their stocks, their bonds, and bring all that capital back home to Japan. And that, my friends, has enormous consequences for everyone. It could lead to a weaker US dollar, put some serious pressure on the stability of the US bond market, and it could make international assets outside the US look a lot more attractive. Generally, it just increases financial instability across the entire globe. So, after looking at all these interconnected forces, what is the new market reality? What are the key takeaways from this really complex and rapidly changing environment? What does it mean for you? All right, here's what it all boils down to. Think of this as your 2026 playbook. First, just get used to volatility. This geopolitical risk isn't a temporary thing, it's a permanent feature now. Second, diversification is more important than ever. Relying on just a handful of big tech stocks probably isn't the winning strategy it used to be. Third, the real economy sectors, we're talking companies that build things and produce energy, are back in focus. And finally, you have to keep a super close eye on central banks. Their every move and all the political pressure they're under is now a critical market signal. And that leaves us with one final and I think crucial question to really think about. In a world where a single political headline can move markets more than a whole economic report, how do we, as investors, as observers, even begin to redefine what risk truly is and how to manage it?